Hello everyone. My name is Fajar Dewangga Alamsyah NPM 24412023 from Accounting Study Program. Here I will explain about consolidation of partially owned subsidiaries. Consolidation of partially owned subsidiaries occurs when a parent company owns more than 50%, but less than 100% of a subsidiary shares. In this situation, the parent still has control, so the subsidiary's financial statements must be consolidated. However, a portion of ownership belongs to other parties, known as non-controlling interest. The objective of consolidation is to present financial statements that reflect the financial condition of the group as a single economic entity. Even with partial ownership, consolidation is required because the parent company has control. This provides more complete and useful information to users. Non-controlling interest, NCI, represents the portion of the subsidiaries' ownership that is not owned by the parent company. NCI must be reported in the consolidated financial statements as part of equity. In addition, the subsidiaries' profit or loss must be allocated between the parent and non-controlling interest based on ownership percentages. Non-controlling interest is usually presented separately in the equity section of the consolidated balance sheet. It is also shown in the income statement as a share of profit or loss that belongs to non-controlling shareholders. This ensures transparency in reporting the ownership structure. The consolidation process begins by combining the financial statements of the parent and the subsidiary. Adjustments and eliminations are then made to avoid double counting. This process ensures that the financial statements reflect the true financial condition of the group. Before consolidation, it is important to align accounting policies between the parent and the subsidiary. If there are differences, adjustments must be made so that the financial information is consistent and comparable. In addition, the parent company must ensure that both entities use the same reporting period. If the subsidiary has a different reporting date, adjustments are required to align the financial statements. This step is important to maintain consistency in the consolidated reports. Another important preparation step is the identification of all intercompany transactions. These include sales, purchases, loans, dividends, and other transactions between the parent and subsidiary. Identifying these transactions early will make the elimination process easier and more accurate. The parent company must also review the subsidiary's financial statements for any errors or unusual items. Corrections should be made before consolidation to ensure that the data used is reliable. Furthermore, fair value adjustments at the acquisition date must be considered. The assets and liabilities of the subsidiary may need to be adjusted to reflect their fair values. This affects the calculation of goodwill and the overall consolidation process. Documentation is also an important part of the preparation stage. All adjustments, assumptions, and calculations should be clearly recorded to support transparency and audit requirements. In consolidation, the investment account in the subsidiary is eliminated against the subsidiary's equity. The portion of equity not owned by the parent is recognized as non-controlling interest. Goodwill represents the future economic benefits expected from the subsidiary that are not separately identifiable. Intercompany transactions such as sales, purchases, and receivables must be eliminated in consolidated financial statements. This ensures that only transactions with external parties are reported. Without elimination, the financial statements may present misleading information. Intercompany balances, such as accounts receivable and accounts payable between the parent and subsidiary, must also be eliminated. These balances do not represent real obligations to external parties, so they should not appear in consolidated reports. In partial ownership, the subsidiaries' profit and loss must be allocated between the parent company and their non-controlling interest. This allocation is based on the ownership percentage of each party. It is important to clearly show each party's share of the company's results. Another important aspect is the treatment of dividends declared by the subsidiary. Dividends paid to the parent company are eliminated in consolidation. while dividends paid to non-controlling interest reduce the NCI balance. Consolidation of partially owned subsidiaries is necessary due to the parent company's control over the subsidiary. This process involves recognizing non-controlling interest and allocating profits proportionally. With proper consolidation, financial statements can present accurate and transparent information. Thanks you. Wassalamu alaikum warahmatullahi wabarakatuh.